Think you know income investing? Perhaps it's time to take a closer look. You're watching The Pitch and I'm Sarah Allen. Today I'm joined by Aaron Binstead from Lazard Asset Management. We're going to talk all things income investing. Aaron, welcome.
Thanks, Sarah.
Why should Australian investors, retired investors, keep Australian equities in their portfolios?
Look, from our view, having equities in the mix is an absolute must. These days people can be retired for upwards of 30 years. And if you're not generating real income growth, if you're just relying on fixed income or cash, inflation is going to eat away the dollars of income you earn every year. And that's simply untenable on a long time frame. So while we think people need a mix, I would not suggest someone is all equities. They definitely want to have it as part of the solution.
What characteristics should retired investors be looking for in their equity investments, and can you give some examples?
Often with income investing, people target a really high percentage yield and pile in on that. Our view is that that can be quite a dangerous way to invest. Just targeting high percentage yield can be quite a volatile and risky portfolio. We do own some of those names, but we also want stocks that can grow their capital and income over time. And we also want different types of stocks that are not all correlated. So things that have different drivers, as opposed to having a portfolio full of bond proxies, for example, that's all going to work or not work at the same time. So, one example, some perhaps different stocks from an income perspective. A couple we bought late last year were Nickel Industries, the nickel business, and IGO that owns a share in the Greenbushes lithium asset. They are more volatile businesses, but they're at the bottom of the cost curve. They are always going to be profitable and paying dividends. And what's really attractive for us is they are completely uncorrelated to most of the income stocks out there. So at a portfolio level, they contribute really nicely because they move differently, as opposed to loading up on stocks that either all work or don't work at the same time.
How can investors balance the need to invest in equities, which do come with higher risks, with their need to draw down for pensions?
So this is crucial, and this is one of the areas that we really pride ourselves for our defensive Australian equity strategy. So, it's in the name. One of the goals is to be defensive and defend capital. We do that through our stock selection and portfolio construction. They sound like fluffy motherhood statements, but they really can make a difference. And a kind of tangible stat I can give you there is this strategy has been managed for 12 years. In every negative month, the strategy has only participated in roughly about half the drawdown of the general ASX 200. So we really are defending capital. So if people do need to draw down, they're not selling at the bottom. And it's gives them a much more stable ride as they depend on that income to fund their lifestyle.
Some of the larger holdings in the fund fall outside of the usual names people might hold for franked dividends. Why are you finding investing in these companies better for the Sharpe ratio?
So you've hit on two really crucial areas there, Sarah, and I think it's really, really important. Firstly, targeting just the high percentage yield we think is not the right strategy. You need to be growing your capital base over time, because if you're not growing your capital base, you're not growing your income stream. A lot of stocks that have a high percentage yield are not delivering that growth. And while we think they're part of the solution, you don't want to be just completely loaded up on those stocks. So just targeting high percentage yield is risky. Secondly, in terms of the kind of Sharpe ratio that can be delivered and the risk return metric, people who are in pension and pre-pension really care about risk. And that's something that, again, for the defensive Australian equity strategy, we think is a differentiator. So your Sharpe ratio just measures your return relative to your standard deviation. And since inception, over the last 3 years and over the last 5 years, against the Australian share income peer group, we've had top decile Sharpe ratios. And if you even broaden that out and look at the whole Australian active share cohort, we've been top quartile over 3, 5 and since inception. And you can broaden that out even again and look at the Australian balanced fund cohort. And again, top quartile over 3 years, 5 years and since inception. And we think that is really differentiated in terms of what we offer for end investors.
Why do you hold a cash allocation in the fund, and would you ever be fully invested in equities?
The cash component is another kind of differentiator and, in our view, an advantage. Firstly, it is an equity fund. The Defensive Australian Equity Strategy is an equity fund, and it's handsomely outperformed the benchmark since inception. So it's an active, highly performing fund. We really like the cash potential to have some cash for numerous reasons. One, if valuations are really high and you're risking capital, you're not forced to be in there. We don't like chasing income and putting capital at risk. Secondly, sometimes, arguably now, you can get almost risk-free income from cash. And thirdly, the thing I personally like the most is we really see cash as an offensive weapon. when you see sell-offs in markets, be they small or large, you have that dry powder ready to take advantage to drive that next leg of income and capital growth.
What's one thing you'd like retired investors to keep in mind when it comes to investing in Australian equities?
One of the most crucial things, again, to touch on is do not chase high percentage yield. Look at the growth in dollar incomes over time and, focus on that, because that is what you're going to be living on, the dollars you receive, not the percentages.
Thank you for sharing your insights today.
Sure.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.